This episode is brought to you by Atlassian. Atlassian makes the team collaboration software that powers enterprise businesses around the world, including over 80% of the Fortune 500. With Atlassian's AI-powered software like Jira, Confluence, and Loom, you'll have more time to do the work that matters. In fact, Atlassian customers experience a 25% reduction in project duration per year. Unleash the potential of your team at Atlassian.com. Atlassian.
My dad works in B2B marketing. He came by my school for career day and said he was a big ROAS man. Then he told everyone how much he loved calculating his return on ad spend. My friends still laugh at me to this day.
Not everyone gets B2B, but with LinkedIn, you'll be able to reach people who do. Get a $100 credit on your next ad campaign. Go to linkedin.com/results to claim your credit. That's linkedin.com/results. Terms and conditions apply. LinkedIn, the place to be.
This is Optimal Finance Daily. How can I avoid paying PMI, private mortgage insurance, by Laurie Sepulveda of womenwhomoney.com. And I'm your host and personal finance enthusiast, Diana Merriam. Thanks so much for joining once again. I'm here narrating for you every single day from some of the best articles on the web when it comes to money and finance. So without further ado, let's get right to today's post and continue optimizing your life. How can I avoid paying PMI, private mortgage insurance, by Laurie Sepulveda of womenwhomoney.com. You've been saving for months or years, but you're still far short of the amount you need for the traditionally advised 20% down payment on a new house to avoid paying private mortgage insurance. When saving up for a new home, especially your first, it can feel like forever before you're able to save the tens of thousands of dollars you'll need. For most home buyers, that amount will take a while to save. Are there other options besides putting 20% down? Many lenders will allow a smaller down payment of 10% or even 5%. But they require home buyers to take out private mortgage insurance, or PMI. PMI is insurance the homeowner pays in exchange for a smaller down payment. This insurance protects the lender, that is, the bank providing you with a loan, in case you stop making mortgage payments. According to Investopedia, you typically pay between 0.5% to 1% of your loan balance per year in PMI on a conventional loan. If you buy a $265,000 home with 10% down, your loan balance would be $238,500. This means you could expect to pay up to $198.75 per month or $2,385 per year in PMI. This insurance premium is added to your monthly mortgage payment. Once you've made enough payments to achieve at least 20% equity in your home, that is, you owe less than 80% of the home's value, according to your latest appraisal, you stop paying PMI. In our example, if we assume a 30-year mortgage at 4% interest, it could take more than 6 years for the principal of the loan to be paid down that far. This could mean over $14,000 just in PMI payments. Is there any way to save on or avoid paying PMI? There are some mortgages allowing you to pay the cost of PMI upfront with what is known as single premium PMI. This will require a more substantial initial payment, an amount anywhere from 1% to 2% of the loan cost. In most cases, this amount will be much less than an additional 10% down payment. You'll also end up paying less PMI over the life of the loan. Negatives of having PMI. It might seem tempting to trade the cost of $200 per month or an upfront payment of several $1,000s for getting into a home earlier. However, there are some downsides to paying PMI. Apart from the fact that you'll have an additional monthly cost you'll never recoup, buying a house with less than 20% down means you'll have a higher mortgage payment and you'll pay more in total interest, all because your loan amount is higher. You also run the risk of being in a negative equity situation if you have to sell your house in the next few years. putting down 20% insulates you from fluctuations in the value of your home from year to year. It also helps ensure you're indeed in a financial position to buy a house. Many new home buyers get deeper into debt because they fail to budget for necessary home maintenance. This includes smaller items like tools, lawnmowers, or ladders, and major home expenses like painting the home, replacing appliances, or putting on a new roof. Does it ever make sense to put less than 20% down on a home purchase? There are plenty of reasons why people choose to buy a house with a smaller than 20% down payment. Maybe you found a terrific deal in your dream neighborhood. If you wait to save a more significant down payment, you'd lose the opportunity of a lifetime. If you're risk adverse, you may wish to have more cash available for an emergency fund. You could also plan to accelerate the principal mortgage payments on your home in a few months or years, wiping out your PMI fast. Or maybe you need a house now because your family is growing or you're relocating. Just be aware that over the life of your loan, you'll pay not only PMI, but higher amounts of interest because you took out a bigger mortgage. That means your total cost can be a lot higher than just the cost of PMI. What if I don't have a 20% down payment and I want to avoid paying PMI? There are several things you can do if you want to avoid paying PMI. One option is to take out a second mortgage. Some lenders will allow you to do this by setting up a home equity line or taking out a second loan. Be warned though, you'll generally pay a much higher interest rate for the second mortgage than you will for the first. Another option is to rethink your plan. If you have less than 20% to put down, you might consider revising your budget and buying less house, or a condo or townhome instead of a single-family home. While this is generally a less fun option, you could consider buying a fixer-upper and renovating it slowly as you save up for it. You could also look into buying a duplex or a house with a mother-in-law suite instead of a single-family home. Then you could rent out the extra side of the house or suite within your home. This way, you could earn extra money to help you pay down your mortgage and get rid of your PMI payments much faster than going it alone. What makes the most sense for you? The most important thing to remember is that personal finance is personal. Even if experts recommend putting 20% down for a home to avoid paying PMI, there may be a different option better for you. Just be honest with yourself about what you can genuinely afford before you sign on for a mortgage that will be with you for many years to come. You just listened to the post titled, "How Can I Avoid Paying PMI? Private Mortgage Insurance?" by Laurie Sepulveda of WomenWhoMoney.com, and I'll be right back with my commentary. Buy low, sell high. Buy low, sell high. It's a simple concept, but not necessarily an easy concept. Right now, high interest rates have crushed the real estate market. Prices are falling and properties are available at a discount, which means F.I.R.E believes now is the time to expand the F.I.R.E flagship fund's billion-dollar real estate portfolio. You can add the F.I.R.E flagship fund to your portfolio in minutes by visiting fundrise.com/OFD. That's FUNDRISE.com/OFD. Carefully consider the investment objectives, risks, charges, and expenses of the F.I.R.E flagship fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/OFD. This is a paid advertisement.
Ryan Reynolds here from Mint Mobile. With the price of just about everything going up during inflation, we thought we'd bring our prices down. So to help us, we brought in a reverse auctioneer, which is apparently a thing.
Mint Mobile Unlimited Premium Wireless. How to get 30, 30, bit to get 30, bit to get 20, 20, 20, bit to get 20, 20, bit to get 15, 15, 15, 15, just $15 a month? Sold!
Give it a try at mintmobile.com/switch.
$45 upfront payment equivalent to $15 per month. New customers on first 3-month plan only. Taxes and fees extra. Speed slower above 40 gigabytes in detail.
When I bought my house, it was important for me to avoid PMI. So I got a little creative and actually used one of the strategies highlighted in this article. I had the 20% down payment, but it was pretty much all the cash I had on hand, and I didn't want to part with it all for obvious reasons. So I found a lender that let me pay half of my down payment with a HELOC, also known as a second mortgage or home equity line of credit. I ended up paying that off in 6 months, and I only paid around $200 in interest. It was totally worth it for the peace of mind. However, I didn't realize that most HELOCs have variable interest rates. So while the loan started with the same interest rate as my mortgage, I was shocked to see that in the 6-month period back in 2018, my interest rate went up 3 times. 3 freaking times. And that resulted in the interest rate being almost a whole percentage point higher than I thought I was signing up for. Boy, am I glad I paid that off quickly. And I would only recommend this strategy for people that have the same ability to pay it off very quickly. But that'll do it for this episode. Have a great rest of your day, and I'll be back with you again tomorrow, where your optimal life awaits.